Hey there, I'm Alex. It's been a couple weeks since the Daily Defiant mapped the contagion from the collapse of FTX, the collateral damage. Well, a lot's happened since then. Bankruptcies, rumored bankruptcies, fresh allegations of dishonesty, an international regulatory skirmish, interesting on-chain developments, and a man who seems to think legal advice is overrated. Thanks to our sponsor Radix, more on them in a moment. Sometimes companies fail, screwing over their customers and investors. But sometimes those companies are so big they can't help but knock out a couple others on their way down. FTX is one of those companies. It had a $32 billion valuation, held funds belonging to a number of other crypto firms and many retail investors. And it had invested in dozens of projects. Finally, the broader this collateral damage, the more scrutiny its collapse will invite of crypto writ large. The broader the damage, the longer this crypto winter will last. This is a story about Contagion, so let's start with the latest big one. Last week, on November 28th, BlockFi filed for bankruptcy. In court filings, BlockFi went out of its way to paint itself as the antithesis of FTX, well-run but victim to forces outside its control, specifically FTX and its sister company, Alameda Research. There are a number of things at play here. For example, you might recall that FTX and BlockFi struck a deal this summer, never consummated, that would have seen FTX acquire the crypto lender. But one bit of information to have come out of court filings in this is the fact that Alameda has defaulted on a $700 million loan from BlockFi. After that, everyone's attention turned to Genesis Global Capital, another crypto lender. As BlockFi and FTX had a week earlier, Genesis on November 16th halted withdrawals. Everyone naturally wondered, would it too file for bankruptcy? And, more importantly, what would such a filing mean for its parent company, Digital Currency Group? DCG subsidiary Grayscale holds roughly $10 billion in Bitcoin and hundreds of millions more other crypto assets. And some feared a Genesis bankruptcy could force DCG to liquidate Grayscale and dump its Bitcoin on the open market. Fortunately, that seems unlikely at the moment. Those of you who've been keeping up with this show this week know that there's speculation that Orthogonal Trading may be insolvent, having missed a $10 million payment on Maple Finance over the weekend. Maple and M11 Credit, which underwrote the loans, alleged that Orthogonal Trading misrepresented its financial condition in the days after FTX's collapse. According to a post from M11 Credit, Orthogonal Trading won't be able to fulfill its obligations as a borrower because it held substantial assets on FTX. M11 also alleges that Orthogonal tried to dig itself out of its FTX-sized hole by trading. Just a couple days earlier, trading firm Oros had missed a $3 million payment on Maple. M11 blamed that on a short-term liquidity issue at Oros triggered by the FTX insolvency. On Monday, Nexus Mutual, a crypto insurance firm that had invested in M11's wrapped Ether pool, said it would bail on the fund, but insisted its losses would be less than 3% of the company's assets and would have no impact on its ability to pay claims. Then there's crypto lender Salt. On November 15th, they too halted withdrawals. Finally, Singapore-based Amber Group on Tuesday denied that it was on the brink of bankruptcy as suggested by some on-chain observers. Quote, "Weathering through market cycles, we have to constantly adjust and pivot our business strategies, product offerings, and as a result, internal teams and functions," it said in a statement. Amid all this, Binance, the world's largest crypto exchange and one of the central players in the downfall of FTX, announced it would establish a $2 billion industry recovery fund to stem some of the bleeding. Applications have been coming in, but few details, such as eligibility criteria, have been released. More on that after a word from our sponsor. Radix has built the world's first full stack for Web3 that's designed to radically change DeFi for the better. From near unlimited scalability and unparalleled security to an asset-oriented smart contract language built for DeFi, Radix is on a mission to decentralize the $400 trillion financial system without the billion-dollar security hacks. Interested? Join RadFi 2022 on December 8th to learn more. Head to the description below this video to grab your free tickets now. Back to our story. So those were all the dominoes that have fallen or seem like they're close to falling since we last covered the FTX contagion. At that time, we noted that the Solana blockchain ecosystem had taken a huge hit, that venture capital firms Paradigm, Sequoia, and SoftBank had written down to zero multi-million-dollar investments into FTX, that Galois Capital and Ikigai Asset Management had enormous sums trapped on the platform, and that Genesis had insisted it lost a mere $7 million when FTX filed for bankruptcy, which we now know is not true. Amid all this craziness, we saw an outflow from crypto exchanges and a bump in DeFi usage. Could it be that some people finally learned the utility of self-custody? Chainalysis thinks not. Instead, increased activity on decentralized finance platforms can be attributed to one industrious MEV bot, an automated program that aims to profit by front-running pending transactions. It can also be attributed to existing DeFi users, Chainalysis argues. People, it's never too late to pull your money from exchanges and other centralized lending platforms. After all, you never know which company might be the next to fall.